Hey everyone, welcome back once again to Accounting Basics. Today, we're going to teach you how to read a balance sheet like a pro. A balance sheet is one of the three core financial statements, along with income statement and cash flow statement. It shows a company's financial position at a specific point in time. In simple terms, it tells us what a company owns, what it owes, and what's left for the owners. Think of it as a snapshot of a business's financial health. Let's start with the assets, the resources a company owns. There are two main types. Current assets, which are expected to be converted into cash within a year. This includes cash, accounts receivable, inventory, and short-term investments. Then we have non-current assets, like property, equipment, and intangible assets, such as patents or trademarks. If current assets are significantly higher than current liabilities, that's a good sign. It means the company is likely to meet its short-term obligations. Next, let's look at liabilities, what the company owes. Just like assets, liabilities are also split into two main types. Current liabilities, which must be paid within a year, like accounts payable, short-term loans, and accrued expenses. Non-current liabilities, like long-term loans, bonds payable, or pension obligations. A high level of debt might be risky, but it's not always bad, depending on how the company manages it and what industry it's in. Finally, we have shareholders' equity, also known as net worth or book value. This represents what's left for the owners after liabilities are subtracted from assets. It typically includes common stock, retained earnings, which is profit reinvested into the company, and sometimes additional paid-in capital or treasury stock. If equity is negative, that's a red flag. It means that the company owes more than it owns. Now that you know the parts, here's how to read the balance sheet like a pro. 1. Check liquidity. Compare current assets to current liabilities. This is your current ratio. A number above 1 is usually healthy. 2. Debt versus equity. Look at how much financing comes from debt compared to equity. This is your debt to equity ratio. 3. Asset trends. Compare the current period to past periods. Are assets growing? Are they being used efficiently? And 4th, retained earnings. Is the company profitable and reinvesting in growth, or are losses piling up? Let's take a quick example. Let's say Company A has $100,000 in assets, $60,000 in liabilities, and $40,000 in equity. This means it's financing 60% of its operations with debt and 40% with owner investment. If current assets are $50,000 and current liabilities are $20,000, that's a current ratio of 2.5. Very healthy. And that's it. You just learned how to read a balance sheet like a pro. Balance sheets aren't just numbers. They tell a story. The more you practice, the better you'll get at spotting trends, red flags, and opportunities. If you found this video helpful, don't forget to like, subscribe, and hit that bell so you never miss a finance tip. Got questions? Drop them in the comments. I'm always here to help.